Good afternoon, everyone. It's been a roller coaster for the fixed income guys. RBI gave everything. First of all, I'm sorry. I'll welcome you all for this post RBI monetary policy discussion with Lakshmi Iyer, who's the CEO of Kotak Alternative Advisors Management Limited. And just a background on what happened today. Lakshmi, we had everything what RBI wanted, or what the market also wanted. So it's kind of liquidity to everyone. Rate cuts also there. Growth centric RBI. The governor also sounded very dovish. Though the external headwinds are there, but I guess market को जो चाहिए था सब मिल गया Lakshmi, as of now, at least for the day. So we like to have your views also on that, Lakshmi.
Sure. Thanks, Mayank. And hi, very good afternoon to each one of you. My title of today's note after the RBI policy was appropriately worded as tariff pe tariff and rate cut pe rate cut. And then why it is so important in this discussion standpoint is because clearly the global central bankers will have to eternalize a new formula, which is tariff shock equal to rate cuts. How do the two things tally in, and why do they tally in? Clearly, because depending on which country you are, the tariff will definitely, or the imposition of tariff which US has done on all countries, including India, especially the key export partners, will definitely see a knockoff on the GDP. Now, just imagine already an ailing global macro, and in that, if you're going to superimpose something like this, which is going to be an extended uncertainty, as I would call it, it clearly. Calls for a recipe for rate cuts. In fact, in my note also I wrote that we had called for a base case scenario of 50 basis points rate cut, which has happened sooner than we anticipated. So the base case having fructified, so we were looking at the terminal rate at least at 6%. Now that seems to be changing, where we are saying that there could be even the dot plots equivalent for India, which we track, which is the interest rate swaps market. It is now discounting another two rate cuts, one in the month of June and one in the month of August. Going back to the policy, not only the rate cut, the stance also was changed. And by the way, the change of stance voting also was unanimous. Now, that clearly tells you two things. One is that the catalyst that was needed, RBI was also waiting for that moment of a catalyst to probably justify the change in stance. And he clarified very well today, saying that accommodative means I can remain status quo or I can cut. And I think that's a very strong messaging to the market today. And I'll come to the markets in a bit. We also need to understand that there is a transmission lag, which means that the moment you do a rate action, for that to move into the economy, takes you anywhere between 2 to 3 quarters, which is 6 to 9 months. And therefore, a proactive central banker, and just look at it. What is the downside for him today, right? Because crude oil prices are down 14%. In the entire of Q1, we are in Q2 of 2025. In the entire Q1, crude oil has averaged at $75 a barrel. And where are we from that price point? Also, we are at least 10% down and raring to go another 10% down. So, just imagine, even if crude settles in at $60-65 a barrel, and you take a $70-75 assumption. If you look at the last year, the financial year 2025 second half, there the assumption was premised, the budget math was on $80 a barrel. So given all that, a 4% inflation number will be reasonably now within the achievable territory, given that the March reading that we will see, we're on 9th today, 3 days from now, that reading will be well under sub 4%, like 360, 370 kind of region. But more importantly, for whatever reason, if the heat wave stokes food prices, even after you bump it up by 30-40 basis points, it's not going to be materially ori. Another math which all of you need to imbibe or keep in mind is that for every 10 percentage points drop in crude prices, the inflation or headline CPI gets impacted favorably by 30 basis points. So I think these are the two numbers. I think just keep this in mind so that you are aware that the reasons for the drop in inflation, and more importantly, the sustainability. The second impact is on the tariffs that we discussed, right? So, while KIE, Kotak Institutional Equities, also did an assessment impact, and, we've gone through various sell side outfits in terms of their impact. While the full impact is still not incorporated, but looking at the tariffs in general, which I wrote in my note also, broadly in the ballpark region of around half percentage point, which is 50 basis points, is what we could see a shave off in terms of growth. But imagine global growth is 3%. Even after 50 basis point, assuming the knockoff, you will still be 100% faster growing than the rest of the world. So I think these clearly are giving very high telltale signs. I keep, I'm toggling between two and just trying to join the threads to tell you that the policy has clearly been set against the backdrop of this massive trade war. And in trade war, typically, nothing, there is no winner or loser. There is somebody who wins more, there is somebody who loses less. I think that is the way, we'd look at it. So therefore, I would say that inflation forecasts will only be surprising on the downside if there are no material inflation shocks from the food front. So I think that clearly, gives us good ammunition. The third lever is on the liquidity. Now, intuitively, if you see in the RBI policy, was there any measure on liquidity? The answer is no. But if you see, the governor, even in the press conference, said that the aim is to ensure proper transmission. And he said that if more liquidity is required, we will provide it. Very, very, very comfortable, statement, and very soothing statement, I would say. So what is that comfortable liquidity? Today, we are at 1.8 trillion rupees, or 1,80,000 crores of system liquidity, banking system liquidity. Now, the RBI will ensure this is in the 1% of NDTL. And that 1% of NDTL, which is net demand and time liabilities, will be approximately 4 trillion rupees, or 4 lakh crores. So I think that is another segues that, today you are at 1,80,000 crores. So you have the leeway. Now, how will this liquidity infusion happen? Two ways. One is through currency market, where RBI does something known as dollar rupee buy sell swaps. So they act in the spot market and they sell in the futures market, so that you get rupee liquidity into the system. And second, we know that the RBI also will do open market bond purchases. Now, how much have they done from, we are in April 2025, from December up until now, we have done almost over little under 7 trillion rupees. So that kind of OMO infusion already has happened, including liquidity infusion. This is entirely done in a combination of these two things. And April month has just begun. The markets already have indication on what kind of OMOs to expect. So I think all of this is clearly focusing on improving this transmission, and also the liquidity which comes into the system. You improve the transmission, and obviously ensuring that your call rates, are hovering around the overnight rate. I think these are the two main things. So I think I found the policy extremely clear. There was no trace of ambiguity. I think that you need to give kudos to the governor to be unabashedly calling a spade a spade. And the stance change, as I said, leaves room for more rate cuts. So should we be at 5.5 or 5.75? I do not know. But the fact of the matter is, it is not resting at 6%. Now, if that were to be the new world order, what are we supposed to do with rates? Well, our answer remains the same, cliched and old, which I wrote in my note also. Go long rates. We continue to be invested. Typically, when rates come down, even interest rate sensitive start doing well, which is typically the banking sector and all. Now, somebody might ask, why was the banking sector down? So yields were also down initially, and after the press conference, you saw the yields started easing a little bit. And we have, I think, what, an hour more for the markets to close. It is closing slightly on a stronger footing, is what our sense is. So I think if you are deploying incremental capital from here, I think risk reward, you can jog through our multiple notes. We've been reiterating the same thing, that the risk reward clearly favors going long duration, whether you choose to buy a 5-year bond, 10-year bond, 30-year bond, that there is not much fixation. But I think focus on building a good quality government bond portfolio, comprising 5, 10, 20-year kind of bonds, and also focus on building a high carry portfolio. Because the only risk which we've been highlighting for the last 6 months is reinvestment risk. And now that is starting to manifest with banks cutting their deposit rates, NBFCs cutting their deposit rates. So all in all, it will give you some more leg room or elbow room to at least lock into high rates, whether you want to do fixed deposits. But our point is that if you want market upside, that will come in only from participation by either buying bonds instead of deposits, or buying funds instead of the money lying in your savings account. Even if you're doing a liquid fund kind of an investment and substituting that, instead of doing your savings pot, you are better off. What kind of opportunities we think will do well in this market? You can do maybe a uh, if you want to do a bond portfolio, maybe you can focus on a blended duration of anywhere between 5 to 8 years. That's a good way to do. You can do long duration funds where the focus is only starting 15 years and beyond. There's nothing right, wrong about it. It's all a function of your risk appetite, how much you want to fathom it. So I think that's one way to go. The second is, we like the bond space, even at the current levels, and these yields may not sustain. There's a reasonably high probability of 10-year heading towards the 6-quarter region over the next 2 quarters, between now and probably the next couple of rate cuts. The terminal benefit funds buying is reasonably strong. They wanted long bonds. RBI gave long bonds and they anchored it pretty well. So I think that process will continue. And given that, though it's not a direct substitute, given that equity markets are going to remain in choppy waters, the incremental money, at least for those investors who've the newborn, I would say the COVID born investors who came in just 5 years back, I think they will have high watermark expectation from equities to sustain their investments. Some of those monies also can get wired into debt. And I think therefore, focusing on a nice, good quality portfolio. We like credit. It's not that we do not like credit, but be mindful of the underwriting standards. I think that is going to be very, very important. Don't carte blanche put your money into any credit instrument or any credit fund. I think both of them will require immense due diligence. So I think keep that on the anvil. Is there any risk to any of this view? Always, there are two risks which I can highlight, post which I'm happy to open this up for Q&A. But one is clearly the yuan depreciation or the devaluation risk. It's a very, very live risk. The the dollar index has actually gone past or pierced below the 103 mark on the depreciating side, and it has moved actually 4 big figures from 107 to this level. So clearly the dollar is on a weak wicket at the current juncture, the dollar index. But we need to also see what kind of covert operations, or surgical strike on its own currency, China will do. Will it devalue its currency to maintain its export competitiveness? And today, what is happening is there is a proverb which says, when two fight, the third wins. But in this case, when two are fighting, the third is losing. So, there is not going to be a scenario if China devalues its currency, the Asian currencies will be spared. So even Asian currencies will be under pressure. So I think this is a very, very live risk. Am I foreseeing crude as a major risk? Answer is no. But yes, food prices. This is the hot patch of the year, as I would say. And then given the hot patch, if there are going to be, substantive heat waves which are wrapping in the country, or sometimes even premature rains. Some parts of India have already got rainfall and just is April starting. So, some of those disparities and those fluctuations in adversities in weather, which neither you, me, nor RBI have in control, I think those are the key risks that, we are foreseeing in our, in this entire math. But, if you are in that duration bucket, which I just mentioned with a moderate duration, duration, I think it's pretty much okay for you to be able to withstand that risk, even if that happens. Yeah, so I think that being the risk, it's okay to play the markets and position yourself for the next 20 to 30 basis points rally over, and I'm giving you a next 4 quarter view. But if it fructifies in the next 6 to 8 months, then one needs to be agile enough to cut your positions and move on. So I think that is something which we will keep opining through our notes, through our messaging, through our podcast from time to time. But I think that's something which we need to keep in mind, that we will take our profits off the table also pretty dispassionately, the way we are recommending you to take positions. Yeah, so I think that's it from our end. Happy to add on, or anything, Mayank, that you want to add.
Lakshmi, one question, and that's a similar question what we have in our chat also, is that we've seen that we've become very, very immune to the global yields. So irrespective of where the US treasuries keep on moving, what we've seen is that either the demand supply is so good that we probably don't react in a negative fashion, but otherwise we've been very, very immune to any upside on the yields on the global side. So do you believe that we are moving to a very different world where that volatility is something will not affect us, and even if hypothetically the debt problem of USA is not getting solved by lower rates on the operational side, and they still maintain a 4.5 kind of level for most parts because of the fiscal issues, do we still believe that this could be a spoiler towards our rate thought process?
So I actually, good you brought this point. I missed covering that in my talk. So, if you look at the US yield and the Indian yield, the spread is at an all-time low. US at 4 and India at 6.5 has made the spread just at 2.5%. And now US yields have spiked to 4.5, and Indian yields are under 6.5. And that has, further crunched the spread. Now, when these yields are at all-time low, it's a big moral hazard for foreign institutional investors to pump in their money. So are we completely, I would say, dichotomous? Are we completely away from, or broken off from the USEs? Well, the answer is not really. We can't be completely. The only saving grace is Japan and China in that order hold the highest US government bonds, and in India is the Indian banks who are holding the government bonds. So there, there is selling pressure. If you see yesterday, after all this Trump tactics, the first auction of 3-year treasury happened, $58 billion, and there was a very, very tepid response. That's where the yield came in higher, and that sparked the next round of sell-off. So 30-year in the US actually traded at 5%. So I think those reasons which I just articulated will prevent any sharp drop in yields in the near future. So I think that volatility will remain. Are we completely divorced from US yields? I would say not. But yes, the fact is that are we obsessed and losing our sleep over US yields moving so high? Again, the answer for that is no.
Now, Ishmi, I'll read through the question. One of the questions is what happens if China starts selling US treasuries, which is close to $800 billion. Then the other question I'll just combine the question is that the US debt maturing is around 9 trillion, which if they refinance at 4.25, then how do you see the impact on these higher rates? And the last is your view on the
One
US
question,
yields.
I get all the questions. What was your
Yeah.
first question on China starts
Selling.
selling
Yeah.
treasuries?
They start selling their whole treasury because of the fight.
So they will see, honestly, they can't afford to do that. The first answer is, will they afford to do lock, stock, and barrel exit? Answer is no. Because if they start dumping treasuries, they start, it's self-goal for them
Self-goal,
also.
yeah.
Because they will devalue their portfolio itself so badly, because yields will just spike up. So that I'm ruling it out, that they will not dump it entirely. But are they net sellers? By the way, last year also they were net sellers of US treasuries. So they have been diversifying into gold. So that is a reality, and they are going to continue to do that. Can they accentuate the pace a little bit because of the hostility which US is displaying right now? The answer is yes. But yes, if they start selling aggressively, to your point, it will at some point in time will start biting into the Indian yields also, because you will see flight of capital from India at 5% on 30-year 10-year bond in the US. Why would anybody want to own your country at 6% or 6 quarter? So please understand, the linkages are very, very strong, and you will actually see exodus from India also. But for the fact, there the small tempering factor, as I call it, is the fact that Indian bonds are now part of the index. So that is the only silver lining, as I call it, that
Right.
will. On your second point, that you have maturities.
Right.
And we are borrowing at whatever 4 quarter and whatever 4 half. So my answer to that is, an indebted nation is a virtually bankrupt nation. But the fact of the matter is, if you are controlling the world's currency or the reserve currency of the world, that is the only thing which is stopping you from, I would say, defaulting on your obligations. So the fact of the matter is that the fiscal deficit will widen. Point number one. Is the threat of the ratings वगैरह, that is not applicable to the US at all. So US in some sense is like a Robinson Crusoe maroon on an island. And as I said, the only Brahmastra is the US dollar, which I think for the foreseeable future in all our careers will still be the reserve currency of the world. How much ever we say that there'll be a troika of currencies, or gold standard or oil standard, all that is great. Uh, I would say book writing tactics. I would have read at least a dozen books which have been calling the demise of the dollar from my childhood days, since I entered the market. And now towards maturity phase also, the same thing continues. It's not really changed. But yes, it will definitely impact the fiscal deficit. It will impact the interest outflow for any country. That is not desirable. And US is no exception to that extent.
Perfect. Thank you, Lakshmi. Lakshmi, any views on the maturity profile of Indian government bonds, as in the government borrowing program? They've been extending their borrowing, as in their maturities to a certain extent. So I guess that's gonna continue for some time now, at least.
It's a fair you're
Yeah.
talking about FY 2026?
Yes, mota mota for
Yeah, yeah,
25,
it's
26
very,
is largely perfect.
yeah, yeah, it's
And
a very balanced.
the other questions are all about, will China devalue the currency, and which sectors will perform if the earnings seasons are going to start? How is the season, and which sectors will probably perform and which are worst?
Yeah, so will China devalue its own currency? Well, even India is devalued. So yes, will China, push comes to shove, devalue its own currency when you and me are sleeping? The chances are pretty high. I would assign 7 in 10 probability. I don't know why I'm not giving it 8, 9, or 10, because China being China, they can do anything whenever they want. But yeah, chances are pretty high. Earning seasons are already underway. It is going to be a mixed performance for now. We like inward facing sectors which are largely consumer driven. Consumer discretionary is having a slowdown. I was sitting with the promoter of one FMCG company yesterday, and he was telling me that there are serious demand issues, and they were all looking, and that's why the conversation on rate cut happened. So yes, rate cut is going to be a necessary ingredient. Is it going to be the only ingredient? Probably the answer is no. Look at BFSI. We still like the BFSI space, the banking and financial services space, whether it's the NBFCs or whether it is. See, remember, liquidity equal to lending. So when you have more liquidity, that formula automatically opens up your elbow room towards lending. Banks so far have been crying foul because the system liquidity was negative, 2 lakh crore plus. Government was not spending, advanced tax outflows happened. All of that is to some extent resolving for itself. So yes, BFSI is a space that we should continue to focus with an expectation of a positive overlay, and more inward facing sectors. You saw what happened to the tech sector today. We've been for long voicing that services exports are going to be hit. Services exports to US are going to be hit. In fact, I also tweeted today, the probability of layoffs is now at 72%. Last year compared to 2024, the probability is only rising. So in this year, there is a 72%, the poll is revealing that, there is a website which tracks this, which is talking about the layoffs being higher in 2025 than it was in 2024. So all that makes us a little bit, I would say, circumspect on the IT sector as a whole. There may be cherry picking of stock opportunities, which definitely we will look at.
Perfect, Lakshmi. The other question is, which part of the curve you like the most, 10, 15, 30 year, from a fresh allocation perspective?
So I think you can be there in the belly of the curve. That's a nice sweet spot to be in. You are not really getting that kind of significant delta in yield pickup. That part of the yield curve, once it inverted, it got completely steep. Now also the curve is reasonably steep depending on which segment you're looking. If you look at 1 cross 10, there is a reasonable steepness. So you're okay buying that 10 to 15 year kind of a segment. I think that is the most liquid and a sweet spot for your ownership.
Perfect. One of the questions is that on tariffs. Now, if the tariffs persist, do you believe the private capex investment will slow down and the uncertainty impacting the demand on the funding side as well?
Yeah,
And the
it
other
will.
is on the global impact, the China tariff of 104%.
Yeah, so all of this is still unraveling. It is like Kahani where you thought Vidya Balan is roaming with a baby, and at the end you realize she is roaming with a pillow. For those who have not seen the movie, I've leaked out the suspense or the climax, but it's a very old movie. But the tariff movie, the tariff Kahani, as I would say, is unfolding exactly in that manner. And definitely it will slow down because look at it in this way, you are a businessman in an uncertain environment. What will you do? First thing you'll do, you'll become a snail, no? You'll actually withdraw your
Yeah.
spends, you'll withdraw your tentacles. That's exactly what private sector is going to do. And they will want to wait and watch what is going to happen. Another thing which is happening in the US, if you see, is the junk bond yields. The
Hmm.
spreads have hit its, the COVID levels. That is so. These are all, clear-cut telltale signs of uncertainty, which is there in the system. And it is not just going to impact the globe. As I said, India also will be impacted. There is no two ways about it. And China is the biggest trade partner today with US, and that is the reason that the hope is that they arrive at a conciliatory or a mid path to ensure that this doesn't burgeon into something big. The other way to look at it also, okay, we can say that, okay, this is the peak of the pain point which is behind us in terms of incremental. It could be just in small tranches, so we don't have to excessively vex over it. So our markets gradually approaching its bottom. I'm not saying we have bottomed out, but are we gradually coming towards the bottom? The answer is yes. So in that breath, we think that US yields will be a very important harbinger for us. Trajectory wise, it should be headed lower, no doubt, but because there is going to be renewed pressure of foreigners selling, and their auctions not going through the way they, I think it is going to be on a wiki on a sticky wicket, at least over the next couple of months, so that one track lowering of the interest rates in the US may not happen unless Fed gets up decisively. Trump in one of his tweets said that the slow Fed should now act. So it is basically targeting specifically at Trump, at Powell, saying that it's now high time that you relent with a rate cut.
Lakshmi, one question from my side. Is it fair to assume that once this tariff Kani probably settles somewhere, as well as what Mr. Trump is asking for low real rates, lower dollar, that is what he's asking for. If that starts to happen, then come what may, how good that they can talk about, the dollar capital will flow to emerging markets and we would be a beneficiary at a point of time again. So that trigger is something that should
Absolutely.
happen somewhere down the line.
Absolutely. As we speak, we were chatting with we had a con call with a couple of our foreign LPs, foreign investors, and they've already started having those conversations that, if this happens, what is it that we can do? What's in it for us? How do you think we can allocate more capital? Because uncertainty is something which people seldom like in the investment world. So you have to plan for it. So clearly, emerging markets will be a very strong beneficiary of such foreign pots of capital. As I said, Mayank, I would still think that foreign investors will probably want to wait and watch on the sidelines before making. They will keep their I would say skeleton ready, and actually wait before taking the actual plunge to fill life into it.
Thanks, Lakshmi. One last question, I guess, is already there that about the other liquidity generator, which is the government spending. So last year has been very muted, but looks like they've got the act again and started doing something or the other. So government
Yeah.
spending is very low, and your thoughts on impact on the growth as well as GDP.
So, capex growth was in the negative territory in the almost second half of the last year, and that got accentuated towards the end of the year as well. But that's intuitively true till the time you've not really seen that kind of, capex, or, companies spend on infrastructure or capex, etc. But given the fact that if you are bracing for a slowdown globally, it is imperative that we start accelerating the pedal on government spending. And that will happen to our mind, not so much on a lag basis, but as I would say, the rate cut also is acting as a very strong tool for that. It's one of the tools, I would say. I always call it a necessary condition, not a sufficient condition. But clearly, are we likely to see better government spends in FY 2026 over FY 25? The answer is yes.
Perfect. Lakshmi, I guess you're done with all the questions.
Superb. So I think, yeah, that's it. So broadly to summarize, the time to bond continues. Pick and choose the right kind of assets. Don't get excessively carried away only by yields. Underwriting and structuring, if you are looking at, is going to be exceedingly, exceedingly important. Sovereigns is something which we like, and I think you can ride the curve at least for the next 12 to 18 months very comfortably. Yeah. Thank you so much for a patient listening. I think
Thank you,
tomorrow's
Lakshmi.
a holiday. Bye. See you.
Thank you, everyone. Thank you for being a part of it. Thank you.